Hey, YouTube. If you've ever wondered, what is APR? How does APR actually work? Does it affect your credit score? And do you get to choose your own APR? Well, you're in the right place. Without any delay, let's get right to it. So let's start with the basics. APR stands for annual percentage rate. It's the yearly rate shown as a percentage that tells you how much borrowing money will cost you. Now, even though it's called annual, APR is actually used to calculate your interest every single day. Sounds backwards, right? Don't worry, we'll clear that up in a second. Here's the deal. If you pay off your credit card in full every month before the due date, APR doesn't really affect you. That's right. If you're never carrying a balance, you're basically borrowing money for free. People who do this are sometimes called freeloaders by credit card companies, not because it's a bad thing, but because the bank doesn't get a dime in interest from you. This is the best way to use a credit card. Use it, pay it off, and avoid interest. But if you carry a balance, meaning you don't pay off the full amount each month, then APR becomes a big deal. That's when the credit card company starts charging interest. And they don't mess around. Now, you might be thinking, do I get to choose my APR? Not really. Your APR is based on your credit score and credit history. If you have a high credit score, you'll usually get a lower APR. If your credit score is low, you'll get a higher APR, and that means you'll pay more interest over time. APR is the bank's way of judging how risky it is to lend you money. Low risk equals low APR. High risk equals high APR. Even though APR is an annual rate, the interest is actually calculated daily. Here's how it works. Let's say your APR is 18%. The credit card company divides that by 365 days to get a daily rate, in this case about 0.93% per day. Then they calculate how much money you owed on average each day during your billing cycle. Multiply that average balance by your daily APR and by the number of days in the billing period. That's how they figure out what to charge you. It's not just based on what you owe at the end of the month, it's based on your daily balance. Sneaky, right? If you have a balance of $1,000, 0 cents, and your APR is 18%, you could end up paying around $15, 0 cents a month in interest. And more if your balance grows or your APR is higher. Over time, that adds up. And it's money you're giving away just for borrowing. That's why it's so important to either pay off your balance every month or work toward lowering your APR by improving your credit score. So what's considered a good APR? The average APR in the US is around 15 to 20%, but this can vary a lot. If your APR is below 15%, you're doing well. If it's above 20%, that's on the high side. And you may want to shop around or call your card issuer to ask for a lower rate. Yes, you can actually ask for a lower APR, especially if you've been a good customer and your credit has improved. So to wrap it up, APR stands for annual percentage rate. It's how much interest you pay when you carry a balance. The better your credit, the better your APR. And if you pay your card off in full every month, you don't pay any APR at all. If this helped you understand APR, hit that like button and share it with someone else who's still figuring this stuff out. And if you have more questions about APR, credit cards, or anything else, drop them in the comments and I'll make a video on it. See you in the next one.